Welcome back to TruePath Finance Australia. Today we're breaking down one of the biggest proposed property tax changes Australian investors have seen in years. And honestly, most people still don't fully understand what's actually changing. You've probably heard headlines like, negative gearing is ending, depreciation is dead, property investing won't work anymore. But the reality is much more nuanced than that. In this video, we'll explain what the proposed 2026 budget changes actually are, how depreciation still works, what changes for investors, and why many experienced investors may simply adapt their strategy instead of leaving the market altogether. Let's break it down simply. Before we begin, this video is for general information only and does not constitute personal financial advice. It does not take into account your objectives, financial situation, or needs. You should consider seeking independent professional advice before making any financial decisions. The headlines made it sound like property investing was finished overnight, but that's not actually what was proposed. The changes mainly target established residential investment properties, purchased after budget night, that generate tax losses, and importantly, the deductions themselves may still exist, but the timing of when you can use them changes. Negative gearing equals property expenses, rental income. Example expenses, interest, repairs, rates, insurance, property management, depreciation. Here's a simplified educational example. Let's say you earn a salary of $120,000. Your investment property earns $30,000 in rent, but your expenses and depreciation total $43,000. That creates a $13,000 rental loss. Under the current rules, that loss can often reduce your taxable salary income immediately. So your taxable income falls from $120,000 to $107,000. This is why depreciation schedules became so powerful for investors. Depreciation is often a non-cash deduction, meaning you may claim deductions without physically spending that amount each year. That can improve after-tax cash flow, reduce taxable income, and make holding property easier financially. Under the proposed rules, things change for certain investors. If you purchase an established residential investment property after budget night, from 1 July 2027, your rental losses may no longer reduce your salary income immediately. This is the part many people misunderstand. The loss itself doesn't disappear. The depreciation deduction may still exist, but instead of immediately reducing your salary income, the loss may get carried forward for future use. So the government isn't necessarily removing the deduction. They're changing when you can use it. Those losses may potentially be used later against future rental income or future property capital gains. One interesting outcome is that these reforms may push more investors toward new builds. Why? Because new properties are expected to retain more favorable tax treatment under the proposal. And new builds often come with stronger depreciation schedules as well. I also think this could accelerate interest in commercial property. Commercial property already attracts many sophisticated investors because it can offer higher yields, longer leases, better cash flow, and different depreciation opportunities. Importantly, the proposed restrictions are targeting residential property, not commercial property. Another major shift may be how investors structure their purchases. Some people may start exploring companies, trusts, SMSFs, or alternative ownership structures, but this is where professional advice becomes critical. Structures affect tax, asset protection, lending, estate planning, and borrowing power. Another important reminder, these are proposed reforms announced in the budget. The final legislation could still change, be amended, be delayed, or include additional exemptions. The government's stated goal is to improve housing affordability, particularly by encouraging construction of new housing and reducing investor demand for established homes. Whether these changes achieve that goal will probably become one of the biggest debates in Australian property over the next decade. One thing history teaches us is this: wealthy investors usually don't stop investing because rules change. They adapt. And I think these reforms may push investors toward better cash flow, better structures, different asset classes, and more strategic investing overall. This content is provided for general information only and does not constitute personal financial advice. TruePath Finance Australia exists to help Australians understand how the financial system works, in plain English. If you found this helpful, consider subscribing for more general education like this.